All right, today we're going to crack the code on something that seems super complicated, but is actually, well, it's surprisingly simple. We're talking about the absolute core of all business finance, and it's all built on just 3 golden rules. Let's get into it.
Debits and credits. You've heard the words, right? And let's be honest, for most people, they sound intimidating. They feel like this secret language that accountants use to keep the rest of us out, like there's some big mystery to it all.
But here's the thing. It's not a secret. It's not a mystery. The entire system that modern finance is built on, this thing called double entry accounting, it all boils down to 3 simple, elegant rules. Once you get these, everything else just clicks. So you ready?
Okay, so rule number 1. It all starts with people and entities. You have to remember, every single transaction in a business is an exchange. It's an exchange between different people or companies or organizations. It's all about the who.
And this brings us to what are called personal accounts. Now, that's just a term for any account that represents a person, a supplier, a customer, a bank. You get the idea. It's all about keeping track of who is giving something and who is receiving something.
And here it is, the first golden rule. It's been around forever, and it's beautiful in its simplicity. Debit the receiver, credit the giver. That's it. For any transaction, you just have to ask yourself 2 questions. Who received the value, and who gave the value?
Let's make this real. Imagine a customer who owes you money. That's a debtor. Finally pays you. They hand you cash. So who's the receiver here? Your business is. You receive the cash. So you debit the cash account. And who was the giver? The debtor was. They gave you the money. So you credit the debtor's account. See? The receiver gets the debit, the giver gets the credit.
Awesome. So we've covered the who. Now let's move on to rule number 2, which is all about assets and things. This rule is focused on the what of the transaction. You know, the actual stuff, the property, the assets that a business owns. In accounting, these are called real accounts. And this is just a category for all the tangible things and even intangible things that a business has. We're talking cash, buildings, computers, inventory, you name it. If the business owns it, it's probably a real account.
In the second golden rule, it's just as logical as the first one. Debit what comes in, credit what goes out. All you're doing here is tracking the movement of your stuff. Is it coming into the business or is it leaving the business?
So let's look at another example. Let's say your company buys a new laptop and you pay for it with cash. What comes into the business? The laptop, the equipment. So you debit the equipment account. And what goes out of the business to pay for it? The cash. So you credit the cash account. Simple flow. 1 thing in, 1 thing out. It's perfectly balanced.
All right, 2 down, 1 to go. We're on to our third and final golden rule, which is all about incomes and expenses. We've done the who and the what. Now it's time for the why. This is how we track whether the company is actually making any money.
And this is the world of nominal accounts. Think of this as the company's scorecard. It's where you track all your sales, your revenue, any gains you make, but also all of your costs, your salaries, your losses. This is the part of the books that tells the story of profit or loss over time.
And our final rule is maybe the most straightforward of them all. Debit all expenses and losses, credit all incomes and gains. It's that simple. If it's a cost to the business, it's a debit. If it's money earned by the business, it's a credit.
Now here's where it gets really cool, because we can see how the rules all work together. Let's say you pay your monthly rent. Well, rent is an expense, right? So according to rule number 3, you're going to debit the rent expense account. But how did you pay that rent? With cash. And what's cash? It's an asset, a real account. And in this transaction, it went out of the business. So according to rule number 2, you credit the cash account. See how it all connects and balances out?
So there we have it, 3 rules for 3 different types of accounts. But the real magic happens when you put them all together. You get this system of, well, perfect balance every single time.
This right here, this is your cheat sheet. This is everything. For personal accounts, people and companies, you debit the receiver, credit the giver. For real accounts, your assets and stuff, you debit what comes in, credit what goes out. And for nominal accounts, your performance, you debit all expenses and credit all incomes. That's the whole engine of accounting, right there on one slide.
And what this all leads to is the most important concept of all. For every debit, there is an equal and opposite credit. Every single time, no exceptions. This means the books always balance. And that isn't just some neat little trick. It's the very foundation of financial trust. It's how we know the numbers are reliable.
And that kind of leaves us with one final, pretty amazing thought.
This incredibly simple logic, debit the receiver, credit the giver, it was figured out centuries ago, way before we had spreadsheets or supercomputers, and yet it hasn't changed. So the question to really think about is, how does this simple, elegant logic continue to power the entire mind-bogglingly complex global economy we all live in today?